Let's take a look at the Asian markets. Remember, Wall Street was jittery in yesterday's trading session. The Dow fell, and that was on account of uncertainties around the U.S. and China trade negotiations. Commentary coming in from the U.S. Commerce Secretary saying that they're still far away from the deal that was awaited. However, the Asian markets shrug off those concerns. The Nikkei higher by about 0.6%, and that's also aided by mild weakening in the dollar yen. Remember, sometime last week, the dollar yen was trading at around the 108 handle. From there, it has weakened to about closer to 110. That's good news for Japanese exporters. The Korean markets too, that index has outperformed for this week and is doing fairly well in today's trading session as well. The Korean index led higher by a couple of chip makers and heavyweights. We have Samsung Electronics as well as SK Hynix. Similar is the sort of gains that we're seeing in Straits as well as the Taiwanese indices. Both of them up by 0.3 to 0.6%. So the SGX Nifty, remember yesterday we were mildly flat, 16 points in the green, 18 points led by Reliance, and the last news coming in from Yes Bank, all of that aiding sentiment. We are in a range. Let's see where we go after this 40-point uptick that the SGX Nifty is indicating.
Well, let's talk about the U.S. markets then. It was a mixed close for indices amid lingering concern over U.S.-China trade negotiations. The Dow dropped 22 points. The S&P 500 ended flat with a positive bias, and the Nasdaq Composite outperformed, rising 0.7%. CNBC's Eric Shemi gets us a wrap of all the action on Wall Street.
U.S. stocks finishing the day mixed, with the Dow losing 22 points, the S&P adding 3, and the Nasdaq higher by 47. The number of Americans seeking unemployment benefits falling to a 49-year low last week, pointing to a strong labor market despite the ongoing government shutdown. Jobless claims dropping by 13,000 to just under 200,000 total applications. But the number of furloughed federal workers seeking unemployment aid, that number doubled from the prior week. PG&E shares spiking 70% after California investigators cleared the utility company of blame for the October 2017 Tubbs fire. It remains undetermined whether PG&E will be found liable for the recent November fire, California's deadliest, which killed at least 86 people and destroyed about 14,000 homes. And if you were waiting on the iCar, you're going to have to be patient. Apple dismissing more than 200 workers from Project Titan, its autonomous vehicle group. That's according to people familiar with the matter. The Project Titan layoffs were billed internally as a restructuring. That's the action from the U.S. market. Back to you in Mumbai.
All right, with that, we go on to our coverage coming in from Davos, starting with an important voice coming in from there. James Gorman of Morgan Stanley expresses concerns over the prolonging U.S. shutdown, which he believes is a straightforward problem that demands solution. Talking about markets and Fed, he adds that he expects moderate rate hikes come by in 2019.
I personally feel it's extremely negative if this shutdown goes on much longer. Firstly, at a human level, you've got 800,000 families affected by this. This is not the way the U.S. should be working. And I truly hope the leadership of both sides come to some way of resolving what seems to be a relatively straightforward problem. I recognize we have a wall. It's 500 miles long. We've had it for a long time. It's been sponsored by both Democrats and Republicans for a very long time. If there are some sensible additions to be made to that wall to improve border security, let's make them, right? At the same time, we have a lot of children affected by the DACA legislation. Let's make some accommodations to those kids and their families. That's the obvious solution. Everybody wants to get back to a market that reflects what's going on in the economy. The challenge is obviously the difference opinion of what the Fed policy should be. And given the 4 rate increases last year, the signaling around that, will the Fed truly be data dependent, including market data, in determining what to do? Market sentiment, market volatility, market liquidity, the temperature of the trading rooms around the street, these things matter. And I think the Fed is digesting that. And, you know, my expectation is we'll have much more modest rate increases in 19.